Hello, everyone, and welcome to another edition of Sustaining Sustainability. I'm your host, CB Bhattacharya, Professor and Director of the Center for Sustainable Business at the University of Pittsburgh. This week, I'm delighted to say that I'm joined from our hometown, Pittsburgh, Pennsylvania, by Martin Jarzebowski, Director of ESG, also known as Environmental, Social, and Governance, and Responsible Investing at Federated Hermes, a global investment leader with $630 billion in assets under management and nearly 2,000 employees in offices worldwide. Martin leads the integration of environmental, social, and governance metrics, popularly known as ESG, across all asset classes and responsible investment solutions. He is a former portfolio manager and serves as an adjunct professor of sustainable finance at the University of Rochester's Simon Business School, and is also affiliated with the CFA Institute ESG Technical Committee, the Sustainability Accounting Standards Board, Harvard Law School Institutional Investor Forum, and is also a regular Forbes ESG thought leader. Federated Hermes has over 60 ESG subject matter experts and one of the world's largest stewardship and engagement databases with 18 years of proprietary data. Martin, welcome to the show.
Thank you very much for having me.
It's our pleasure. Martin, you have served as an adjunct professor of sustainable finance through the pandemic and continue to teach an MBA course on the subject. What are some key lessons for corporations or any of our listeners interested in ESG and sustainable investing that have emerged over the past 3 years?
There's plenty to unpack in that first question. But first, let me say that it's an honor to work with so many talented MBA students. In my class, they tend to refer to me as an elder or geriatric millennial. So it's great to see the next generation of responsible business leaders and investors. I'll give you my top three observations over the course of the past 3 years or so. Number one, transparency. Number two, materiality. And number three, engagement. So starting with transparency, I get a lot of questions around the macro drivers of ESG demand and how it went mainstream over the past couple of years. And my own belief is that there simply is a proverbial carrot and the stick, meaning changing consumer preferences and regulatory policy. So consumers are looking for greater transparency around the products they consume, which has created a rising tide around sustainability. Regulators are following suit with increased disclosure requirements, and both corporations and investors are responding to this dynamic. Number two is materiality. What I mean by materiality is that ESG is not a one-size-fits-all approach. Different environmental, social, and governance issues can be more or less financially material for any given industry. A biotech is different than a bank. Different business models, different fundamental drivers, different valuation metrics. So why would you assume that their ESG risks are exactly the same? They're simply not. So financial materiality will be the basis of what certain industries disclose and what investors evaluate in the future. Now, finally, engagement. Investors are becoming more proactive owners of the companies they invest in, regardless if it's a pension, an endowment, an investment manager, or an individual. They're increasingly going directly to the source for their ESG insights by engaging in a collaborative dialogue with the board of directors and the C-suite of thousands of companies in which they invest. Now, it affords the opportunity to better understand the ESG risks of that company, identify potential mispriced opportunities in the marketplace, but also to keep a seat at the table to advocate for positive change. Now, I consider engagement to be the future of active, responsible investing.
That's an excellent explication, and very clearly, you must be a popular professor. Let's take a step back, and in this context, let me ask you, what is Federated Hermes' purpose? Because we've been hearing a lot of talk about corporate purpose these days. And how does this purpose influence your responsible investment strategy?
CB, simply put, our purpose is stewardship. Today, we manage over $600 billion and engage on behalf of over $1.6 trillion under stewardship. But something we cannot forget is that it's not our money. It's our clients' capital. and they have long-term goals for their money, which we invest on their behalf. This is why we have an official Federated Hermes pledge, which underpins our global firm-wide commitment to always put the clients first and to act responsibly and transparently. And we're proud to say almost every single one of our roughly 2,000 employees has signed the Federated Hermes pledge. Now, that translates well into a spectrum of responsible investment solutions. Instead of treating environmental, social, and governance information as something separate and distinct from traditional investing, we made a commitment to integrate ESG and engagement across all asset classes, meaning public market investments as well as private market investments, stocks and bonds. It's not something to keep off to the side and relegated. Rather, it's an integral part of the investment process and the primary research for every single investment team. And that's why we built an in-house division of 60 subject matter experts dedicated specifically to engagement and responsible investing. So think of it as the intellectual property which helps us achieve our overarching mission, which is long-term sustainable wealth creation for all of our clients.
Very well put. Thank you for that. Now, as we are always trying to improve ESG literacy for professionals across a range of industries, can you help clarify what the difference is between the traditional values based investing versus today's spectrum of ways that ESG is involved in investing? What are the differences that groups like the CFA Institute are teaching that would be helpful for more people to keep in mind?
Yeah, historically, there's been a lot of attention paid to reflecting one's values through an exclusionary approach. So, this style of investment was typically referred to as socially responsible investing or faith based investing, or many people today simply refer to it as negative screening. But the portfolio construction of that approach is very linear. And if you think about removing particular sectors, they're very much hard, fast restrictions. You can think of it as screening out what you did not want to invest in order to reflect a person's own preferences. Now, today, there's been an evolution towards an inclusionary approach, meaning having a thesis on how well a company is adapting to a more sustainable business model, irrespective of which industry it competes in. There's a clear convergence between financial objectives and mission based outcomes. Now, a popular approach is ESG integration, where environmental, social, and governance information is used as a natural extension of the primary research which is performed by investors. So think of it as information a prudent investor would want to know to mitigate risk and identify mispriced opportunities in the marketplace. Now, off of an ESG integration foundation, you're now seeing more mission based strategies, which are thematic in nature, such as a low carbon fund or more impact driven investing. A good definition of impact is a measurable environmental or social benefit derived from the companies you invest in. So think of impact investing as having a dual mandate, meaning not just investing in a company because its inward operation and its practices are managing ESG risk better than its peers, but also identifying companies whose products, meaning their goods and services, have an additional positive outwardly benefit to people and planet. Now, opportunities for betterment, they can include secular themes such as circular economy, improving health, agriculture, water scarcity, clean energy, and education. But from an investment perspective, the basis of positive impact generally ties to a company's products and the long-term solutions they enable.
And let me just follow up on that one. Are you guys actually monetizing the impact that investments in ESG are likely to have? And is that the basis on which you decide to invest?
Well, think of it this way. You're trying to look at what is measurable from the impact, right? If you think about a sustainable business model, you have the products and you have the practices. And the products, those solutions that they're enabling, if you're able to very clearly measure their outwardly impact on society or on the environment, that is an additional benefit that you could be seeking from that investment. So I like to say that that's going beyond just identifying an investment from a risk mitigation perspective around potential poor practices that could have brand and reputational damage. That's one type of input. But when you start to think about that additionality of having a positive outwardly impact, that's something that all of a sudden starts to go beyond just financial objectives and makes it very much mission based solutions.
Got it. Thank you. So, as you well know, we've spent a lot of time discussing climate disclosure in the last few months and the SEC mandate, etc. Can you help our listeners understand the role of consistent and comparable disclosures here, both in the US and around the globe?
Yeah, from an investor perspective, the value of consistent information is about measuring and managing risk, and climate data is no exception. So, to effectively price climate risk requires data points which are forward looking, comparable, and can be translated into financial decisions. So, society has spent hundreds of years developing financial accounting standards, but really, we're only scratching the surface or beginning to see climate and carbon reporting at a global scale. So, as it stands today, I think we're continuing to see a rising tide of carbon disclosure. And you can think about, let's just say, the US right now, about 70% of the S&P 500, which is a very broad market index, they already have measurable scope 1 and scope 2 direct carbon emissions. And you're right, the SEC's new climate risk disclosure proposal, which is still in a comment period, it's likely to go into effect later this year, and that will only increase the level of carbon transparency in the USA. Now, it's going to become common for corporations and their assurance providers, consultants, and accounting firms to implement the right talent, the people, and the processes to manage and measure climate related financial risk. So think of it in terms of physical, transition, and regulatory risks, which are all things that a prudent investor would want to know. So physical, meaning a company's physical assets, including its property, plant, and equipment, which may be at risk of depreciating faster than expected. Transition, as in how a company will be adapting their workforce and their supply chains and the communities in which they operate in, which may be at risk of disruption. And then finally, regulatory, where more regions are mandating greater transparency around climate and carbon disclosure. Now, these are all long-term structural risks, which require strategy, good governance, and very strong execution. Now, that's going to take time, resources, but also a collaborative dialogue with financial stakeholders in order to help in this long-term transition.
Very well put. Thank you for that. Now, one thing I struggle with is the seeming disagreements amongst these ESG scoring systems, which has invited quite a bit of criticism as well, because, what do these ratings really mean? As you know, Elon Musk came out and Mike Pence and all of that. So, what are the strengths and weaknesses of these ESG scoring systems?
It's a very topical item right now. And so, the ESG scores, they've become very popular as a way to make a relative comparison among companies in the same industry on the basis of their ESG profiling. It's almost like a profiling tool that allows you to try to make that relative comparison. And that's where you see a lot of that criticism. So I'd like to say that ESG scores are a really good starting point, right? Because they help you potentially identify red flags or controversies. And that can only be in the beginning of your research process. But it's not necessarily going to get you to the finish line. And that's because the vast majority of third-party ESG scores, they are based solely on corporate disclosure aggregation, meaning the scores methodology is based mostly on what the company self-reports in the public domain. And a lot of the different scoring systems have now started to go a little further than corporate disclosure aggregation, and they try to use AI and natural language processing to sort of scrape the web in order to gather more information. But still, you have to remember, as a result of these mechanical processes, many ESG scores are updated very infrequently, as in maybe only once per year. They can also be backward looking. And probably more importantly, different vendors can have different methodologies. So, as you pointed out, one company could be considered an ESG leader by a certain provider, and that same company could be considered an ESG laggard by a different scoring system or a different methodology. There's a great paper by MIT called Aggregate Confusion, which also talks about that a lot of these third-party scores actually have a very low correlation. So that begs the question of which one is right. So I think the real takeaway here is that there is no easy button for ESG assessments. And there's simply no substitute for doing your own homework and going directly to the source by actively engaging with a company. And that allows you to better understand the ESG risk, better understand whether or not the marketplace is appreciating some of these risks, and also being able to kind of keep your seat at the table and advocate for positive change.
Indeed, fascinating stuff. And I hope that over time we will see more convergence with increasing disclosure, that we will see more convergence in those ratings so that we as a community have more confidence in what decisions we are making, investing decisions that we are making. We are running short on time as always. So, Martin, what call to action would you make to our listeners?
My recommendation would be to take the long view and really try to take a step back and depolarize sustainability as a whole. Good investors and responsible business leaders, they really know how to distinguish short-term headlines from long-term structural changes. And if we all focus in on transparency, on materiality, and collaborative engagement, then I think those actions will lead to prudent risk mitigation, adaptation, and strong stewardship for generations to come.
Martin Jarzebowski, thank you for spending some of your precious time with us today.
Thank you very much for having me, and great to see the growth that you're experiencing with the Center for Sustainable Business.
Thank you very much. And before I sign off, I do want to say that this podcast is made possible with the help of my colleagues, Chris Gassman, who is Associate Director at the Center for Sustainable Business, and Gabby Pogel, who is a marketing specialist with the Center for Sustainable Business. I'm your host, CB Bhattacharya, and I'll be back in a couple of weeks for another edition of Sustaining Sustainability.